All right, that's a good cue to go ahead and get started. All right, good morning, everybody. Thank you for joining us. Today we have Eric Seal and Matt Coe from T. Rowe Price presenting our mid-year market update. Or Eric and I were talking before. This always seems to be a timely call, although when is it not with the constant, new happenings in and around the world in the market. So, with that, I will let Eric introduce Matt, and you go ahead and take it from here, Eric.
Hey, thanks, Sebastian. Appreciate it. Good morning, everyone. My name is Eric Seal. I'm the regional sales consultant for T. Rowe Price, based in Maryland and supporting financial advisors in Pennsylvania and West Virginia. Today, you're going to walk away with some, as Sebastian said, timely market insights, along with some actionable investment ideas that you can start to implement now within client portfolios. So we're going to cover a number of themes impacting global markets today, where T. Rowe Price is kind of tactically positioned across asset classes and opportunities that we see entering the second half of this year. So to help lead the discussion, I'm joined today by Matt Coe. Matt's a portfolio specialist within our $540 billion multi-asset franchise, and he's a pretty key voice at the firm when it comes to communicating our market viewpoints. And Matt has over 24 years of investment experience, 9 of which have been at T. Rowe Price, and he's also a CFA charter holder. So I'm going to hand the conversation over to Matt here shortly to provide his updates. Then we'll open the conversation up to you guys, whatever's top of mind for you, whatever's closer to your practices, investment market-wise. We want to hear from you. So think about questions as Matt is going through his presentation. And after Matt presents and we go through the questions, I'll just provide a brief recap, highlight some of the investment strategies to consider available to you at Cambridge. I do want to point out that yesterday was actually the 118th trading day of 2025. And those 118 days have been the most volatile, chaotic, and uncertain we've seen in a very long time, including that period of COVID in March of 2020. And during times like this, I'm kind of reminded of a quote from T. Rowe Price's founder, Thomas Rowe Price, and he said, "Change is the investor's only certainty." And what you're going to get from T. Rowe Price is our active approach in managing clients' assets. And our job is to really stay on the right side of that change and navigate markets responsibly. And this has become even more important as T. Rowe Price has grown from a firm that managed just a small handful of clients here locally in Baltimore of wealthy families to the $1.6 trillion in assets that we manage today. So over the last 20 years, I'll point out also that our active approach has led to a much higher success rate when we talk about beating passive funds. So T. Rowe Price, out of any top asset manager that you can think of, Vanguard, Capital Group, JP Morgan, we outperform passive a larger percent of the time, 71% of the time, and we do it by a greater amount, which is about 78 basis points on average. So what you're getting with T. Rowe Price is not only keen insights that Matt is going to share, but also one of the more adept active managers in the asset management business. So we have the capabilities, the resources to help you and your clients thrive as markets continue to evolve. So with that, I'll hand the conversation over to Matt. Thanks, Matt.
Yeah, thanks, Eric. Thanks, everyone, for joining this morning. I love that stat you just shared, right? Like T. Rowe Price, as a firm, we are really good at active managers. Like 78% of the time, we beat passive benchmarks. What I love about being on the multi-asset team is that statistic is even better. 91% of the time, we beat like pretty much all the other multi-asset managers out there in the entire industry. And we do that through a combination of, one, our starting point is a lot of like all-star, 4 and 5 star rated funds, medalist funds for Morningstar. So I can sort of clone those securities, into a portfolio for my balanced fund or for my global allocation fund or for my even target date funds, right? Not only that, though, we spend a lot of time within the multi-asset team around how do you design a portfolio, right? How do you structure that? What are all the pieces you want? What are all the weights you want? And then on a month-to-month basis, we make tactical allocation decisions. We make overweight, underweight decisions on sort of risk on, risk off, growth value, U.S. international, sort of all the iterations that you may be thinking about, you may be weighing with regards to your client portfolios. Those are things that we do on a monthly basis in a very systemized format, also gathering insights from our broader research platform, from our CIOs, from heads of equity and fixed income. And so some of those insights are what I want to share on this call. Now, I am working from my basement. This has been a terrible week for me. I don't know if everyone's on. I believe everyone's on the East Coast, but that heat dome is like it's spreading. It's like 95 degrees. My son wasn't on lacrosse camp yesterday, and the coach told me you got to pick him up early. It's 120 degrees on the turf right now, and it's a 9-year-old kid, right, wearing a helmet and pads, and so he's screaming about trying to get out of the house today because he saw what was like yesterday's heat dome effect, and so he doesn't want to get out the door. So it's been a terrible morning for me. So what I'm going to do, right, for the purposes of this call is I'm going to shut off my camera. You'll still hear the audio connection, but I'm going to share my screen, or hopefully I'll be able to share my screen and go through some slides to help frame the narrative around what we're doing with regards to our asset allocation portfolios. So give me a second here. Eric, give me a thumbs up. You can still hear me. All right. So what I'm going to do is maybe highlight half a dozen slides or so that help frame what are some of the big decisions that we're doing within our investment portfolios. And a lot of it is still tied around tariffs. I know the market today, right? It seems like we're going back to sort of all-time highs in the next day or two or a week or two. And the market is looking at tariffs as being more of a rear view phenomenon, right? There was Liberation Day, the market sold off in April, it quickly reversed course. We're going to get trade deals, right? And all the good things to come from not just a trade deal, but this Israel-Iran thing seems to be on pause maybe, right? So all the good things are only to come, and that just means, right, continuation of the trend. That's what we're seeing. That may be from a technical backdrop, and that may be from a momentum signal. However, from a fundamental perspective, we're still quite worried. And what we see is, right, this chart here just shows how much higher the tariffs are relative to the last 100 years of American history. So if you look at pre-Liberation Day, if you look at the blue line, 2.5%, that was an effective tariff rate, right? So for all the goods that are coming to America, it's about a 2.5% effective tariff rate. What's likely to occur is, even with the quote unquote deals that we're going to have, in reality, there won't be a lot of trade deals. We may get a trade deal with the Japanese, South Korea, India. The rest of the countries are just not going to get a trade deal. What they are going to get is just a blanket baseline tariff level. And why that is, and this is our guess as to why that is. This is much just too cumbersome, much too, it takes way too much time, way too much negotiation to go sort of country by country, line item by line item to actually get a trade deal. And even with, right, some of these sort of, friendly countries, right, Japanese, Koreans, and Indians, we're supposed to get these trade deals. These trade deals that were announced a month ago are just taking a very long time. And the headlines are not coming back from, are not as sort of pronounced from the administration regarding trade deals. It almost seems like it's sort of radio silent, because what those trade partners realize is that in order to actually do this correctly, it'll take a very long period of time. The administration is sort of moving on from that. What they're likely to do is just say, okay, 10% baseline tariffs or 15% baseline tariffs, and sort of everyone just kind of pays that, and we'll move on from it. If you look at where that is, though, it's somewhere around maybe the purple, the red dot is sort of where we're going to be for all countries minus China, including China, which has an effective tariff rate right now of 50%. That gold dot of around 15% comes down a little bit, somewhere around like the 13, 14% level. So the effective tariff rate at the end of the day is going to be about 5 times greater than what we had for, right, the last 20 some odd years, right? Certainly before, so the experience that we had coming into this year. And why that matters, right? Well, why that matters is we have a tremendous amount of uncertainty. And the uncertainty, as measured by, right, like what the government's going to do, economic policy, trade policy, is just leading to business indecision. It leads to, right, intentions around hiring, intentions around building manufacturing plants. But based off of the insights we gather from our research platform and the 10,000 meetings we do every year, the executives are essentially saying, we're just waiting this out. We don't know what the administration is going to do. We don't know if the administration is going to last another year until it gets into the midterms, and maybe some of this stuff gets on pause, and by the time the administration's out, right, then it's going to get, all this is going to be reverse course. Many manufacturers are telling us in closed door meetings that it is actually much more effective to actually pay the tariff and still manufacture overseas than build anything in the United States. Now, that's not to say that you're not going to have some hedging, right, some movement of goods and materials and manufacturing plants in the United States. But this is all at the margin. This is not going to somehow deliver on the administration's grand ambition of massive manufacturing resurgence in the United States. What it is doing right now, though, is creating a lot of uncertainty, creating sort of a pocket of sort of indecision, which, if that is also confirmed with slowing economic growth or higher inflation readings, right, we could see corporate management teams starting to take actions to try and adjust for that, right? They are beholden to shareholders. They need to manage profits. And if they have to start to eat those higher tariffs in this period of uncertainty, right, where is the positive catalyst going to come from with regards to the economic data? Now, thus far, the economic data itself is largely held in. Now, this is through March, right? If I sort of elongated this through May, it's pretty much the same thing. It's showing real GDP in the United States, at a low stall rate, right? Sort of plus 2%, right? It might be a little bit lower than that more recently. The next few months are going to be really, really important. Right now, what we have is CPI readings that show, right, close, like essentially 2% inflation, right? We're pretty much near the Fed's mandate. We have, unemployment rates extremely low. We have real GDP that's being positive. So it almost feels like it's supposed to be Goldilocks, right? Which goes to the administration's sort of talking points around, Jerome Powell is too late, right? He should be cutting right now. You have a few other Fed governors who are going out there and at least publicly and saying, yeah, it's, we should have, maybe an interest rate cut or two, right? Or three, right? So there's no real reason to have this restrictive rate. The concern, though, is if you have tariffs, who's going to bear the cost of those tariffs? Is it the manufacturer overseas? Is it the exporting company? Is it the importing company in the United States? Is it the retailer? Is it you, the consumer, right? All those parties, to maybe some degree, are going to have to share in the tariff burden. Now, how much, to what degree does that then offset sort of other spending intentions? We don't know. What we know, though, is that the tariffs were levied in April, right? And so it takes a little bit of time for that to work through the system. And so by the time we get into, right, the next few months, if we don't see the data shifting, right, then you could say perhaps, right, this was sort of overblown. The concerns around inflation and the concerns around slowdown and corporate profit hits, right, that was just overblown. That's just more fear mongering, right? This is the great calculus that somehow the administration was to be able to thread that needle and get things done correctly and ultimately extract a lot of gains and no real negative impacts to the economy. Or in the next few months, we'll actually see inflation readings starting to tick up. We'll start to see a more forcible sort of slowdown and consumer spending as prices go up. And we may even see some small dents to corporate profitability. Why that matters is in this period, in this gap before we get real hard data to confirm, right, which way the market should go, we have to sort of zoom out away from sort of the market narratives and sort of possible economic impacts to what is an investor looking at today, right? An investor today is looking at valuations that are pretty much elevated across the board, right? The cheapest place to be, and this is just a 15-year look back, so some of this is biased, right? So this is like valuations relative to the last 15 years. The cheapest places to be on relative valuation is buying bonds, just treasury bonds. Now, that's not to say that treasury bond yields won't go higher. That's not to say that treasury bond yields are only going to collapse and you're going to make a lot of money in treasury bonds. It just highlights that. Think about 15 years ago, you're getting essentially like 0, 1, 2% treasury bonds. Today, you're getting what, 4, right, 4.5. So that just shows on a relative basis, treasury bonds are attractive relative to the last 15 years. But U.S. equities, right, no matter where you buy, large cap, whether you buy growth or value, right, it is expensive relative to the last 15 years. We know that the PE multiple on the S&P 500 is somewhere around 21 to 22x PE. That is a very, very high multiple. So putting it together, you have this period, this gap of uncertainty with regards to which way is economic data going to inflect, right? At best, it's just a continuation of a slow growth trend. And at best, it's just a continuation of the earnings growth sort of trajectory that we've seen thus far. At worst, this is something that kind of takes the economy into a borderline recession. But your starting point is 21, 22x PE multiple. There is no margin of safety if things were to inflect downwards. If things were okay, you're still looking at a market that's overvalued, at least looking at US large cap equities, right? So when we think about sort of probabilistic and then sort of, kind of what are the assumed returns, right? In the very, very short term, perhaps, right, end of the year, if things sort of go okay, you get what, like mid-single digit returns on equities from here on out, maybe low single digit to mid-single digit at best, right? And that's just to say there's no more multiple expansion. You just have a continuation of following the earnings growth trend. At worst, you're probably looking at a revisit to the April lows of sort of below 5,000, right? When we're doing our estimates as to where it would be the clearing price before value investors start really jumping in with 2 feet very confidently, you're probably looking at somewhere around 4,500 S&P to like 4,750. At that point, it's probably the market is so cheap, right? Like everyone is calling their clients and saying, "Give me all your cash. We have to go to the markets right now. This is the opportunity right now." But it's not at 6,000 S&P. It's not at 5,500 S&P, right? It's much lower, and that is the concern that we have in terms of the risk reward sort of framework. So what are we doing about from our portfolio? Well, we're looking for relative bargains, right? So when we look at relative bargains, this is just a starting point, right? Small cap equities look more cheaper. So that's one area that we like. If you look at the purple bands, you see US is expensive on a relative basis. Europe and Japan and emerging markets, so all things international, look at least on a relative basis slightly cheaper. Not that it's on an absolute basis cheap, but it is on a slightly on a relative basis a little bit cheaper. So the areas that we've sort of started with is let's look at international equities and let's look at small cap. Now, when we look at international equities, what we see is that there has been, right, this sort of valuation sort of talking point has been very consistent, at least for the last decade, right? If you look at, the green and purple and the red lines here, you'll see it's consistently been below the US from a relative valuation. It's been cheaper, really hasn't worked. And if you look at where it is now, though, on the far right, that value premium or the valuation premium for the US has only expanded relative to international. And so some of this is justified, right? The US is the only country in the world that's harnessing, right, the true potential of artificial intelligence. It has all these mega cap tech companies that are just, large, companies that are compounding earnings and cash flows and have, right, really no, ability to be sort of challenged in the near term or even medium term with regards to the business prospects. So, a lot of US exceptionalism is more tech exceptionalism. So, some of this sort of premium in the blue line, US relative to the rest of the world, is justified. However, if you peel back the layers of the onion and say, well, what about the S&P 493 minus the Max 7, right? What does that look like? Well, the S&P 493, believe it or not, is not that attractive relative to, a basket of international stocks. They are very, very slow growth profile companies. They don't have wide moats, right? They have, relatively sort of favorable balance sheets, but they're trading at a 40% premium to the rest of the world. So that's where we start to look at, okay, international on an absolute basis looks cheaper relative to the US, but also underneath the hood, perhaps, right, you don't want to sell all of your Max 7, but some of the S&P 493 could be sold, right? Because those fundamentals really aren't that differentiated from international, but they're trading at a huge premium. And what we're seeing right now is that the market is starting to sniff out that, hey, US is okay. You look at the blue line here, the US earnings growth is okay. But now you look at the red and purple bands, right? Emerging markets, Europe, right? You see a huge inflection higher, right? The expectation now is international regions outside the United States are now going to do better. Why is that? Well, while it's not on this chart, much of this has to do with the fact that you have various forms of stimulus. It's really concentrated in Europe, right? The economic powerhouse of Europe is Germany. Germany's passed essentially a stimulus package that's going to increase infrastructure spending and defense military spending. And what that's doing is it's not just building more bullets and missiles, but it's paving more roads. Chemical companies are benefiting. Steel manufacturing is benefiting, right? Trucking companies are benefiting. Logistics companies are benefiting. So what you're seeing is this sort of cyclical uplift that is similar to that of more of like a stimulus measure coming out of a recession. So that means, right, that rising tide is going to benefit not just Germany, but broader Europe. And what we see is other countries looking at that playbook and saying, perhaps, right, they may not have the same ability to do as forceful of spending as Germany is, but you're seeing a lot of European nations saying, the US is no longer the world's policeman. The US is sort of changing its stripes with regards to how it wants to be viewed in the world and its standing and its relationship with even European allies. So a lot of European countries are starting to hedge themselves, saying we need to maybe create our own regional coalition, do it alone, right? Sort of refocus internally. And that we believe is going to create that flywheel that starts spinning for more lending and business and investing activities. That's going to be immensely beneficial for Europe. But think about the starting point again. Cheap valuations with an improving callus and expectations now going up. That's usually the cocktail for oversized, right, supersized returns, at least from an investment perspective. US is, right, expensive valuations with some concerns around, right, the potential growth and, looking at sort of expectations here, earnings growth trajectory starting going downwards. That's not the best sort of cocktail for, right, oversized return. So we like, at least from a framework of US versus international, we like being overweight international, and we've been overweight for the last 4 months or so. We've been increasing each and every month, adding to European equities. Now, I'll end with some thoughts on fixed income. What we look at is, I think, cash for us is really attractive. Cash is paying you almost mid-single digits, right? It's risk-free. And it provides dry powder should you want to deploy into the market, should there be a sell-off. So we like cash. We're barbelling that with high yield bonds. Now, what this chart shows here is if you look at the blue line, that's economic policy uncertainty. So uncertainty with regards to the economy and what the Fed's going to do. And you see the blue line is pretty much near record highs, right? Right around nearing sort of COVID levels. The green line shows high yield spreads. And high yield spreads are relatively tight, near record lows. And you're not really seeing a meaningful uptick in high yield spreads. And some of this, we believe, is justified. Why that is, if you think about the high yield bonds in like the 80s and 90s, right? Leveraged buyouts, Michael Milken, right? These are like the junk bonds on Wall Street. They are paying you, right, 10, 15, 20%. Over the last 20 years, this asset class has become much more institutionalized. And more recently, at least in the last decade, a lot of the really risky, junky credits that could potentially default, that could potentially have a spread widening event, is out of the traditional high yield universe and is largely now in the hands of the private credit industry. And so what we're left with is when you're looking at the high yield bonds that are outstanding, about half of them are BB rated. So they're essentially one step away from investment grade bonds. And we're also in an environment where economic growth may potentially slow, but it's not likely to go into any type of deep recession. So if you're looking at like the green line and seeing any big spikes, right? The spikes tend to happen around recessions, right? 2008, 2009, right? COVID, right? So if you're waiting for that sort of all clear moment, like get in, right? Be confident. You can't lose money on high yield bonds, right? The spreads have blown out, prices are dropped. It may not happen this time. So for us, we think getting paid 7% in high yield bonds, at least on a relative basis, picking up some additional spread, that's attractive. Now, this chart here, right, the takeaway for some who just kind of following from the outside, just looking at the optics would say, I don't know, uncertainty is really, really high. That generally is going to lead to a recession, and that generally leads to massive spread widening. I'll wait, Matt, right, before I get into high yield bonds. And our belief is that moment may not come this time. We're not headed into sort of any type of economic calamity. And so we think it's different this time. We think high yield bonds really aren't going to give you that additional yield that some may be waiting for. But on a relative basis, getting paid 7% in a higher quality asset class is attractive to us. So within fixed income, we have cash, we have high yield bonds, and that's what we're doing within our portfolio and just barbelling the two. So let me stop there in terms of prepared comments. Now, I spoke for about maybe like 20 minutes or so. There are plenty of topics that can be discussed. I can provide some context on, but I really want to hear from the group to see where you want to take this conversation. What's important to you? What are the decisions you're weighing with? And if there's a slide or two I can share, I'll certainly put it on the screen. If not, I'll just sort of voice over some of the decisions that we're weighing and how we've settled on, ultimately the investment decisions we implement in our portfolio.
So maybe I'll kick it off while people kind of think through questions, Matt. Over the weekend, obviously, there was some conflict in the Middle East. What's new, right? The U.S. Struck Iran. What are some of the potential kind of forward-looking impacts as it relates to inflation, oil prices, and ultimately monetary policy if this conflict escalates and we start to see other allies join in, whether it's Russia, China, et cetera?
Yeah, so right now, it very much seems like it's a de-escalating type of event, and that's just more based off of recent headlines, right? Iran attacked, sent some missiles to a U.S. base, military base in Qatar, but at least based off of the headlines and sort of the Reddit boards and others, it seemed like these announcements were made hours in advance, so it had to do more of a retaliatory strike to sort of show face, but not to actually cause any real harm. And so I think they're going to have more headlines, coming from Iran regarding some additional attacks or the lack of wanting to, sort of dial down, right, the rhetoric and the aggression. But in reality, we're not really seeing any real action from the Iranians, nor from sort of their close allies to be drawn into this fight. Right, this very much feels like a targeted, relatively contained, right, sort of event. And so any spikes in commodity prices are going to be rather short-lived, and we believe ultimately return back to the prior trajectory of just sort of lower commodity prices over time. This incident with Israel and Iran and the U.S. would have to be drawn out over several months for there to be real inflationary impacts that would cause broader impacts to the economy and for the Fed to maybe adjust its position. Similarly, when we talk to our natural resources team, our energy analysts, highlight that executives across the board, from major oil companies, smaller drillers, are not looking at this as any opportunity to increase capex for drilling. Right? They would have to see the commodity price staying sustainably higher for an elongated time period before they would start drilling additional wells. What they're seeing is maybe the floor, right? The rock bottom price where oil will settle has moved up a bit, but it does not change anything in terms of how they're calculating what their capex intentions and plans are. So I think this is going to be something maybe in a few weeks' time, more in the rearview mirror, less impact with regards to inflation, economy, and sort of Fed speak.
Got it.
I got a question. Matt, you touched on international and how valuations were a little more attractive there. It seemed like your one chart showed that small and maybe mid caps were kind of in the same boat. Do you feel the same way about them in comparison to U.S. large cap?
So small and mid cap, I have to unpack that a little bit. So we like down cap. What I wasn't able to share was based off of some of our proprietary research regarding down cap exposure. We have, over the last year, maybe year and a half, adjusted our thinking and our positioning to be more concentrated in mid cap, less in small cap. So what we see from a lot of just simple screens is that small cap equities look really attractive. It's similar, as you had highlighted, Sebastian, to international in terms of relative cheapness. But when we work with our research teams and ask, where are those opportunities within small cap, the common response we get is there are no great opportunities. These are cyclical businesses that have poor balance sheets and poor sort of future prospects, right? So what we're all led to believe that small cap companies or the small cap universe is sort of the next mid cap and large cap companies. But in reality, all those high flying companies, whether they're tied to artificial intelligence, whether they're tied to maybe crypto, right? A lot of these companies that are the more durable, high growth profile companies that will eventually become the next mid cap or large cap companies are largely backed by private equity, private venture capital, and they are out of the public universe. The companies that are trading publicly that are small cap are a lot of regional banks, sometimes like SPACs and biotech companies that are a little more of a lotto ticket type of stock or investment. And other companies are just more cyclically oriented, but just really don't have great growth prospects. So for us, that sort of down cap exposure still being cheap makes sense, but we don't want just small cap exposure. So we're more concentrated in mid cap, which have a little bit more of a, at least from a industry perspective, more diversified relative to small caps, and also just have better fundamentals, better growth prospects. So we think if you're going to get down cap exposure, be more concentrated into mid cap.
Thank you.
Any other questions from the group?
I'll add a comment. I appreciate your comment about the cash. I mean, everybody on this call, I'm sure, gets bombarded every day to get your money out of cash and into fixed income. And I think your point makes sense. I mean, Eric, correct me if I'm wrong. I think T. Rowe Price's Treasury is paying, 4.5 maybe right now. Like I think it just makes sense, especially for some more conservative investors, to make that a sleeve of your portfolio at this point. So thank you.
So if no one has any questions.
I do.
We get one question.
Yeah.
All right, Jim.
Hi, it's Jim Williams.
Hey, Jim.
In the play of cash, could you share a couple ticker symbols? My exposure to T. Rowe is mostly in the blue chip growth, international, and the small cap. So I'm not familiar with your treasury plays and cash.
Yeah, I'll thank you for the blue chip business, Jim. You kind of jumped the gun on me, but I'll share maybe our bias towards shorter duration and maybe not a money market. So there's two PDFs that Jody shared ahead of the meeting. One is the complete list of every T. Rowe Price mutual fund, ETF, SMA, model portfolio available at Cambridge. I'll highlight our ultra short mutual fund and also our ultra short ETF. So if you're thinking about, how to kind of move away from or into fixed income and into maybe an alternative to cash, I think ultra short makes a lot of sense. You're getting those attractive yields, in particular, the ultra short ETF, which is T-Bucks, TBUX. Yield to worst on T-Bucks is right around 5%. And if you're looking at the mutual fund, which is TRBUX, the yield to worst is right around the same. So that would be kind of the cash alternative, shorter duration option from T. Rowe Price.
Okay.
And again,
and I one more follow-up question, if you don't mind. I think I missed it on the slide. What is the current PE ratio of the S&P 500?
Yeah, the current PE ratio is right around 22x PE. So that is nearing probably like all-time highs in terms of how high the valuation got. The only time the valuation of the S&P got higher was during the COVID sell-off, and that had more to do with the earnings expectations dropping considerably. And so like the market's not dropping fast enough and earnings getting slashed, so you have a higher PE multiple. And then you have the rebound where you had the V-shaped rebound and right after COVID, and so you had multiples sort of shooting up higher. So it's very rare for multiples to go even higher from current levels.
And Matt, I came up in a time where 15.1 and 17.5 were rich. So 22 is really kind of scary.
It is, and so we thought about that in terms of what is the natural sort of level at which the PE multiple should be, in light of the fact that when you were coming into the industry, the S&P 500 was much more cyclically oriented, right? You didn't have these big tech
Right.
titans that were making, right, hundreds of billions of dollars of cash flow every year. So, so when we think about that, we're like, maybe if you adjust it, right, and this is like tortured data, right? You're constantly making up reasons why, right? Like you're justifying something, but it ultimately comes out to like maybe it's like an 18 multiple. Maybe an 18.5 multiple is sort of like where the natural state of affairs should be for the S&P 500, recognizing that it is much more cyclical, less cyclical, much more technology, much more sort of, kind of steady growth compounding type companies that make up a large portion of S&P 500. So that just said, though, as long as the tech narrative holds, as long as AI spending continues, as long as the benefits of AI, benefit the U.S. economy, then 18.5 makes sense. If, however, what we see is AI was just another fad like metaverse, right, or some sort of other boondoggle that corporates spend a tremendous amount of money for, but have nothing to show for it, I think we could go back to maybe closer to where you started the industry, right? Maybe not 15, but maybe it's somewhere around 16, 17 is like where the valuation of S&P 500 should be.
I was going to say, if we drop out the not so magnificent 7, what would the PE be on the 493?
The 493 would be trading somewhere between 18 and 19.
Okay.
So I think the challenge we have is, if you take out the Mag 7, you look at the S&P 493, it looks like a quote unquote sort of reasonable valuation for the overall markets. However, the S&P 493 also doesn't have the tech companies, right? Like including the tech, it should be somewhere around, right, 18, 19. But minus the tech, it's trading at 18, 19. So again, it's sort of minus the really, really good part of the S&P, you're trading at a premium. So that's the challenging backdrop that we have with where the markets are. Right? But saying all that, I wish it was that easy. I wish it was a simple input-output model, right? Tell me what the multiple is. Here's what the returns are going to be. I wish it was that simple. What we know is, investing is really that simple. It's a multitude of factors, multitude of sentiment and emotions. Kind of all ultimately blend together to generate the output in terms of returns. And right now, we came from certainty in the beginning of the year to the Trump tax plan and business bump and deregulation. Then it was all uncertainty with regards to Liberation Day and tariffs. Now we're right back to certainty that the tariffs are in the rearview mirror, that we're going to get this big, beautiful tax bill, and Israel-Iran won't go off the rails, right? That to us is a big concern, is that we're back to certainty, we're back to premium valuations. And if things were to go awry, right, anything were to go wrong, there isn't that margin of safety, that little, there isn't a level at which buyers will just show up to support the markets unless it's much lower.
Oh, thank you for that. I really appreciate it.
Yes.
It just, you made me think of something real quick. Sorry to take up so much time. Do you have a resource, either you have a resource that shows like historical PE for small and mid cap and international?
Do we have a resource that shows a PE multiple for small and mid cap? Is that what you're asking?
Yes.
So we don't have something to share. We've done the analysis, but we don't have something to share in terms of like a published piece.
Okay. All right. Just curious.
Okay.
All right. Thanks for your time.
Absolutely.
Sebastian, how are we on time?
We got another 20 minutes.
Okay. Jim, thanks for the questions. Any other questions out there before we kind of recap? Okay. So like I mentioned, Jody shared 2 PDFs. One was the list of strategies. The other was a piece called our asset allocation viewpoints. Matt kind of alluded to this in his initial comments. If any of the information that Matt shared today resonated with you and you'd like to receive our insights and perspective on markets, along with our tactical portfolio positioning going forward, reach out to Sebastian. I'm sure he'll be happy to share my contact information with you, and I'll make sure you get that piece, which is published on a monthly basis. So it's essentially a 6 to 18 month forward outlook of where T. Rowe Price sees risk opportunities, but actually how we're allocating, underweighting, overweighting that $540 billion multi-asset franchise that I mentioned earlier. So I want to hit on maybe 3 or 4 strategies to consider. And I'm going to tear up the script a little bit, Matt. I want you to maybe talk about the hedged equity ETF after I'm done, if you're okay with that, because that is available on Cambridge's platform as well. So we talked about tariffs kind of not necessarily being in the rearview mirror as much as the market will like you to believe, and those tariffs might have some lingering impacts on corporate decision-making. The next few months in terms of economic data and inflation will be important, and who ultimately bears the burden of those tariffs will play out. Valuations across the board, specifically in the US, are still elevated relative to history. Coupled with that uncertainty means there's really no margin of safety if things kind of trend downward. In this environment, particularly in the US, we're looking for bargains in the large cap core growth at a reasonable price area of the market. And one of the strategies I wanted to highlight to that end is the T. Rowe Price Capital Appreciation Equity ETF. TCAF is the ticker symbol. It's run by David Giroux, who Morningstar said belongs on the Mount Rushmore of greatest investors of this decade. At the end of last year, David was recognized for his work on the Capital Appreciation Mutual Fund, which beat a record for the longest streak of outperforming peers in the Morningstar category for 17 straight years. So he beat his peer group for 17 straight years, and no other manager has done that on the same strategy of a US equity or multi-asset portfolio. So he is our Warren Buffett here at T. Rowe Price. And essentially what he's trying to do with the TCAF ETF is pick 100 or so stocks out of the S&P 500, provide you outperformance of the SPYs of the world with much less risk, and he's doing it for 31 basis points. So for US equity exposure, TCAF would kind of be the best idea. Matt talked a little bit about international and the opportunity there. The ETH index has actually been supported by improvement in fundamentals in that kind of post-COVID period, but it's still cheap relative to the US. Matt talked about fiscal spending in Europe, in particular Germany, increasing spending on defense and infrastructure, and that could provide additional tailwinds. And our focus at T. Rowe Price has actually been on the value side outside the US, which has proven to be spot on. So the ETH value on an annualized basis has actually outperformed the Russell 1000 value. So the index for US value, large cap value over the last 1 and 3 year time periods. So if you have core exposure in the US or growth exposure in the US, you're actually getting better diversification benefits by allocating to ETH value than you would by allocating to the Russell 1000 value. So the one idea there is our International Value Equity Mutual Fund, TRIGX is the ticker symbol. And that fund is a top quartile performer over the 1, 3, and 5 year time periods. And then we talked a little bit about fixed income, our bias to short duration. I shared the ultra short idea with Jim on the ETF side and the mutual fund side. And then Matt also shared high yield. So the high yield market is actually more quality than you would think, kind of in that post-global financial crisis period. And we don't expect spreads to blow out in the event of a recession or in the event of an economic slowdown, certainly not to the extent that we saw during that COVID period. And at the same time, you're getting 7 and 7.5% in yield on high yield. So we have a US high yield ETF, ticker symbol THYF. The yield to worst for the most recent period on that is a little over 7.7%. So US high yield, ultra short on the fixed income side, international large cap value, equity for your international exposure, and TCAF, our large cap core ETF for your US equity exposure. So I'm going to hand it over to Matt. Matt, I apologize, I threw this curveball at you, but I want him to talk a little bit about the hedged equity ETF that recently launched on the Cambridge platform. That ticker symbol is THEQ.
Yeah, let me pull up a slide to share here. Hopefully you can see this. So what is THEQ, T-H-E-Q, T. Rowe Price's hedged equity strategy? As the name implies, what we designed is portfolio where day one, it's invested about 80% into just U.S. large cap core, actively managed by T. Rowe Price. It mirrors the security selection for our what's known as structured research, or one of our flagship large cap core equity offerings, managed by our analysts. So think about it as like a T. Rowe Price research analyst portfolio. That performance itself is quite stellar, right? On a risk-adjusted return on an absolute basis, it outperforms passive S&P 500. Now, what we have in addition to that, though, is if you look at this slide here, a number of additional sort of what we call overlays, or the way I like to think about them are tools with which we can flex the portfolio to have additional equity exposure, or to introduce things that will ultimately hedge the downside and provide more sort of downside protection. We have equity index futures, so think about options trade, U.S. Treasury futures, managed volatility is the process with which we use to ultimately decide to overall risk the portfolio or de-risk the portfolio. We also use an allocation to min-vol equities, managed internally at T. Rowe Price. It's a T. Rowe Price integrated U.S. equity lower volatility strategy, right? So the way we think about it is day zero, about for every dollar you put into the portfolio, 80 cents of it is going to be just in a large cap core. Then we're looking at the model, the managed volatility model. What it does is looking at volatility as a signal, as a guide as to what to do with regards to flexing the portfolio for more risk or less risk. And why that is we believe that the VIX itself, and it's not just spot VIX, so if you just pull up the VIX chart telling you what VIX is today, it's looking at the VIX and putting that as an input into a model, and then extrapolating that as to what is the future volatility look like? What is the expected volatility to look like? What we know is typically big drawdowns are associated with high volatility environments. What we also know is some of the big upsides tend to be associated with like sort of low vol environments. And so we're looking at volatility as a guide to help influence our decision regarding how much do we want to flex that 80% into maybe 100% equities, or maybe moving it down to like 50% equities, right? And we do this through a combination of just not that modeling around volatility, but then the portfolio management team looking at what is the best way to achieve that, right? Let's say we're in a high volatility environment, we need to de-risk the portfolio. A lot of systematic strategies will say, it's a high risk environment, use options. Well, we also know this: if the volatility is high, guess what happens to the price of those options? Options are expensive. That's just how options are priced, right? They're built off of volatility. And so the portfolio management team has more fundamental oversight to say, we want to de-risk the portfolio because we are now entering this high volatility environment, but we know the options market is expensive. Maybe we use Treasury futures, right? Buying Treasury bonds, right? They're a futures trade. What happens on risk-off environments? Bond yields tend to collapse and bond prices go up, especially for risk-free Treasuries. What about using just equity options, right? There are times when equity options can be cheap, and we'll use equity options to hedge the portfolio. There's other times where we'll look at it and use min-vol equities. What we know is in risk-off environments, min-vol equities actually hold value and actually do better than perhaps even Treasury bonds. More recently, Treasury bonds have started to lose some of the diversification benefits. What we see is there have been short, kind of brief moments of volatility more recently where min-vol equities did reasonably well. So think about this as a broader array of tools with which a volatility model as the primary part of the investment process, as well as the portfolio management team can choose a broader array of tools to sort of flex the portfolio into more risk or less risk based off of what we think the expected volatility will look like for the markets. Now, I would contrast this with, you could buy a buffered ETF. A buffered ETF will say, right, we're going to protect, X%, and, you're going to be capped on your returns. Well, the trouble with a buffered ETF is that it can deliver on that defined outcome of, right, like sort of max protection or 20% protection on downside, 10% protection on downside. What the buffered ETFs often don't say, though, is when you have that upside cap and the markets do better than that upside cap, how much of the additional returns have you just given up? Right? Some of the leading buffered ETFs the last few years generally tend to be some of the max protection buffered ETFs. And think about the 2 years prior to this year, the markets are up over 20%. So in reality, by buying that buffered ETF, it wasn't that you paid a management fee for the buffered ETF. You gave up maybe combined 2,000 basis points of upside by staying in a sort of a defined outcome. And that is the challenge with what buffered ETFs deliver. If you can predict the future, if you can tell me that sort of defined outcome is ultimately the path of the markets, then absolutely, right? That buffered ETF is going to be one of the best investment choices you can have. What we do know, though, is that markets often kind of do their own thing, regardless of the valuations and fundamentals. And so for us, we take a different approach. We don't cap the upside, but just the same, we can't define the downside, right? We can't tell you with certainty that you're only going to lose, right? The first 10% of losses, right? We can absorb that, and then the 11% and lower, you're going to participate. We can't give you that. But what we do try to do is provide a differentiated risk return pattern that over time we believe will be better than the buffered ETFs, will be better than other hedged equity strategies out there, will allow you and your clients to stay invested in an environment like this. That's elevated volatility, high valuations. We can do it through a manner where you're in actively managed equities, and we can use a number of tools to bring additional equity exposure into the portfolio or de-risk it, but in a manner that we find we believe is more justified and creates more sort of more of a value proposition than perhaps just kind of systematic strategy to say we only use options or we only use X tool. We use multiple tools. We use a quantitative discipline, but we also have fundamental oversight with PMs who can make adjustments and choices based off of what the market is giving us. So let me stop there in terms of like a brief summary of what the hedge equity strategy is. Some of you may have questions, right, with regards to what I just shared. Some of you may be wondering, like, how does this compare with some other product or strategy you may be using? Happy to address any questions you might have.
Take that as no questions. Okay. Well, hey, thank you everyone for dialing in this morning. Hopefully you walked away with some actionable ideas and some greater perspective on the current market environment and things to kind of think about as we go through the second half of 2025. Again, if you have questions, if you want to receive the viewpoints, please let Sebastian know and he'll let me know, and then we'll make sure you receive our thought leadership and pieces from T. Rowe Price going forward. So thank you, Sebastian. I'll hand it back over to you.
Yep. Thanks, Eric. Thanks, Matt. Great presentation from both of you. We appreciate you doing that today. And thank you, everybody else, for hopping on the call. We'll wrap it up there, give you a few minutes back with your day, and stay safe, stay cool out there. Take care, everybody.
Thanks.